The global economy has been evolving drastically in the last decades due to the internet and more recently, AI. These technological advancements have changed and continue to change industries, forcing businesses to evolve to keep up with recent trends. One large evolution in the last decade is the digitization of payments and company management, and that is where Fiserv or FISV comes in. They have been one of the largest players in the core banking system and have recently entered the merchant acquisition segment as well. They have entered their most recent segment through multiple acquisitions, and this has caused turbulence in their stock price. Was this a mistake that will lead to their demise, or is it an amazing opportunity for investors? Let's find out. Starting with their core banking segment, they have been in this industry since the merger of First Data Processing and Sunshine State Systems in 1984 to create Fiserv. They have posted double-digit adjusted earnings per share for 25 years since their merger, but have chosen to grow through acquiring companies who operate similarly in their space. Before their largest acquisition in 2019, they have acquired an incredible 162 companies to grow their core banking segment. These made sense as they were complementary to their core business and expertise, but that is an average of 5 acquisitions per year for 34 years. I'm honestly astonished that a company could acquire that many complementary businesses and grow without any hiccups. They do mention that this is part of how they have and are growing, but to invest in their company, you have to be comfortable that they are a serial acquirer. As they try to grow even more, they ventured into the merchant acquisition space through their acquisition of First Data in 2019 for a whopping $22 billion. To put that into perspective, that is about 67% of the company's market cap at the date of this video. As they tackle this new segment and fight for market share from current competitors, they continue their acquisition spree by adding an additional 17 companies, making a whopping 179 acquisitions in total, or an average of about 4 acquisitions per year. Their acquisitions for their new segment raised eyebrows as their expertise was in handling financial institutions rather than in merchants that have different customer needs. This has led them to overguiding investors, causing their stock to peak on March 3, 2025. From that point on, their stock price has plummeted more than 70% as new management tightens their belt and figures out how to navigate this new segment. So does this mean that their competitive advantage is now under pressure? I would say no, due to a number of factors. 1. They are the largest player in the core banking system. Based on the Federal Reserve Bank of Kansas City, they serve 41% of deposit institutions and 31% of credit unions in the USA. This shows that their core banking system is heavily ingrained in their industry. Number 2. High switching cost. They have a sticky customer base, as changing providers means that they would have to retrain their employees to use the new systems rather than a working system that already fits their needs. This gives them an amazing source of recurring revenues that can support their expansion into their new segment. And number 3, customer-oriented approach. Fiserv's services and processing ability allows them to serve their customers' needs. Aside from providing their software, they are connected to instant payment providers such as FedNow, which creates more value for their customers due to lower processing fees. This gives them an edge over competitors who create this value by taking on the cost versus organically being part of their business model. Now, here's a relative analysis of their largest competitors in each segment. Aside from my usual metrics, I will be using earnings yield and return on capital employed for both comparisons. Return on capital employed is computed by using the company's earnings before interest and taxes, or EBIT, divided by total assets minus current liabilities. Starting with their core banking segment, Fiserv has the best operating margins, but in terms of returning value to the business, this is most seen from Jack Henry or JKHY. This means that Jack Henry deploys their capital the best among peers as they maintain their focus in their segment compared to Fiserv that is trying to compete in another segment. This large difference may also be due to Fiserv controlling a large portion of the core banking system in the USA. Being the largest player can hinder margins as capital returns can diminish as size increases. With that, this actually makes JKHY an interesting company to continue watching. But in terms of an immediate investment purchase, the earnings yield of FISV makes it the best target, assuming that they can maintain their moat. Next, the merchant acquirers that compete similarly to Fiserv are XYZ or Block Inc. and GPN or Global Payments. These three companies compete by providing the POS system while also being the company handling payment processing. In this category, it is undeniable that Fiserv is the best in class. They have the best operating margins while also having the best returns for assets deployed. Partnering this with their large earnings yield at current prices, they are the best investment in this group. Putting these two analyses together, I can say that at current prices, Fiserv is the best target investment in the group. To complete my analysis, of course, we have to look at price versus value. So, for my DCF, I have done my usual conservative estimate and even made a more conservative one with an assumption that the company will not grow owner earnings at all. I have done a no growth scenario as there is a risk that the company will have a hard time competing in the merchant acquisition space due to the lack of expertise they have in this segment, despite their incredible moat in their core banking segment. With both analyses, the company is showing a significant discount to fair value, which makes it a potential investment for my Grand Line portfolio. For my next steps, I will likely purchase the company, assuming that I can get to free up some capital for my current portfolio in the near future. If they are still the best investment at the time I free up my capital, I will purchase the company and be happy to ride the ups and downs of their stock price. Thank you so much for listening to my analysis. For those who are curious about my portfolio updates and changes, please don't forget to like, comment, and subscribe. I will be doing this for future videos as well. Thank you so much.